Hello and welcome to another segment of Off the Cuff with Deb. I'm the broker owner here at Staged Homes Real Estate located in Vista at 335 Main Street, where we offer free professional home staging. Today we're going to talk reverse mortgages, the new reverse mortgage. And I have a couple of guests with me here. They're actually clients of mine, so I'm really excited. Thank you guys for coming. This is Gunny and Rafiq. I have worked with Gunny and Rafiq for several years. We have invested in several flip properties and very successfully. Right. They are now nearing retirement. And now we're talking about their retirement goals, and the reverse mortgage has come up as an option. And so I've invited Cathy Sabater here from Fairway Mortgage. Thank you, Cathy, for joining us today.
My pleasure. Good to meet you.
Yeah, and Cathy's going to talk with Rafiq and Gunny as if we're talking to you, our audience. Some of the questions that they have are going to be the same questions that you might have. And since we're talking about the new reverse mortgage, stay tuned, because there's some information and some new things with the reverse mortgages that now make it even more beneficial for retirees entering into the buying market in the retirement years. So Cathy, share with us a little bit about what is the new reverse mortgage and how is it going to benefit a couple like Rafiq and Gunny? And I know that they have some questions here to answer and ask of you, so let's see how that ends up. So tell us a little bit about reverse mortgages and what's so new about them.
Well, what's so new about them, it has to do with really protecting the clients, right? So the title shows the new reverse mortgage because this is a FHA loan, which means it's guaranteed and insured so that we have the backing of that particular entity. Ben Carlson also earlier this year stated that he's also going to continue to invest money in this.
Okay.
And our hopes and what the trend is that people are going to sign up for the new reverse mortgage as they are for Social Security and Medicare.
Okay, so that's perfect. So it is an FHA-backed mortgage.
Correct.
Okay, which is great because that means it's insured.
Correct.
Okay, perfect.
So let me pull up a picture, and this is really all based on the fact that you have 3 buckets of money, right?
Okay, at retirement.
Pre-retirement and then after retirement.
Okay.
So pre-retirement, you have money from your W-2, from your monthly income that you get, right? Then you invest in 401s, stocks, and bonds. Mm-hmm. And then, of course, you have your equity from your home.
That's right.
So those are your 3 buckets. So when you're planning your retirement, how much money do you need to live retirement or just be retired?
That's right.
Right?
That's right.
So I spoke with an individual and, I need about $8,000 a month. Well, if you do $8,000 a month times 12, right, that's $96,000 a year.
Right.
So how much money do you have in your buckets in order to allow you to do so?
Right.
So that you can actually live in your retirement versus just being retired.
And the reverse mortgage would help in the sense that by doing a reverse mortgage, you actually have no mortgage, right? While you're in that loan, which actually is like, if you don't have to pay mortgage, it's like extra income from your other buckets that allow you to be able to live a good living at retirement. Is that right? That's a benefit.
So basically the way it works, if you use all three of the buckets, you've planned for your retirement, right?
Okay.
So now when you do the reverse mortgage, there is no mortgage. However, it is a mortgage without a payment, which means your principal payment is not going down.
It's
your
going
principal
up.
payment's going up.
Okay.
So now that it's being insured by the FHA, they've done different calculations, and that's really the key, right? So the different calculations now save you from any market shifts. Right?
Okay.
So back in the day, if you had your equity in your home changed, then that kind of affected your reverse mortgage.
Okay.
The way the new mortgage works is that the family can be assured that if anything did happen and it did go upside down, that they're not responsible for any of those losses.
That's right. So it would be an automatic short sale.
Correct.
Versus having to negotiate a short sale with the hope
That's
that
right.
you're actually able to sell the property without any negative consequences. Negative consequences meaning that you have to pay for the shortage,
Right.
or it's going to go on the family's credit. So these are some really great changes.
Right.
I actually deferred a lot of my clients away from reverse mortgages because they didn't offer a safe haven at retirement for the surviving family.
Right.
And that was the issue with them. But with the new changes, I am bringing you guys back to the table saying this might be something, and we don't know yet, that you might want to consider. And I know you guys have brought some questions today for Cathy. So I want you to kind of ask, because you guys are just now in the beginning stages of choosing your retirement home. After several investments and several flips, we're now moving towards that, okay, is this something that's right for us? So what do you want to know about reverse mortgages?
So how does reverse mortgage work for retirees?
Okay. So number one, you have to be at a minimum age of 62.
Okay.
Right? So you're 62 years of age, and now you have the opportunity to use this reverse mortgage. So when we say reverse, it means that because you no longer have a mortgage payment.
Okay.
Okay? So now, let's say you make $5,000 a month,
Okay.
right? You're paying your mortgage and it's $3,000 a month.
Okay.
You only have $2,000 left to live in. So are you going to live in your retirement, or are you going to be retired?
That's
So
right.
you
So can you
have
say that again?
You want to live in your retirement, or you want to be retired?
That's right.
So this is how it really works. Again, we mentioned that the loan is negative, right? Because your principal balance is going to increase, but, right, you're not making a mortgage.
Right.
So now you can breathe and enjoy your retirement. At the other side, you can also get an equity line of credit.
That was the thing that I was really fascinated with, because in the former regulations regarding reverse mortgages, you know, let's say you put 50% down on your property, got your reverse mortgage at 62, you've got 50% of your equity still just sitting there unused that could actually go to work for you to make more money during retirement. And now with this new regulation, we can actually access that through an equity line.
But because of the new changes, you don't have access to all of it.
Right, but a percentage of it.
You have a percentage. So
That's
if
right.
So the reverse works two ways. Let's say I want to stay in my home today.
Okay.
I have a couple of family members. They only make $3,000 a month. Their mortgage is $2,000. They're barely making. They're the living poor. They're not really living their retirement. They're just retired.
Right.
Right. So
paying
all this-
mortgage.
right. So they're getting all this extra stress. So with the benefits of the new reverse mortgage also comes new qualifications. So the other ones, and I can show you a picture of
Okay.
the shift of what happened with the new and the old, in that the old days, you actually used it as a last resort. I don't have any money, I'm gonna lose my home. And so people utilize the reverse mortgage for that.
Okay.
Today, it's more like a financial planning tool.
Okay, that
Right.
makes more sense. Again, why you're here today.
Right.
Yeah.
Right? Let's talk about this as a financial planning tool,
Exactly.
because the changes that are made in the reverse mortgage actually are more conducive to a retirement plan
Exactly.
versus a desperate salvation of a home or a financial situation where you can't afford your mortgage.
Right, so we definitely recommend that you consider doing it when you're 62.
Okay.
Why? Because you don't need it.
That's
So-
right.
So
Okay.
this is how it works.
Okay.
Don't do a reverse mortgage because you need it. Yes, we're gonna try to help you when we can. The olden days is that all you had to do was run your credit, and then we gave you the reverse.
Okay.
So we had some things that happened that people were not able to keep their home because we didn't care about their credit and all those other things.
That's right.
The biggest concern that happened was because they didn't have a mortgage, they forgot that they still have to pay their taxes and insurance.
Okay, so that was another thing. So get this. So even though you have a reverse mortgage, and I know a lot of people ask this question, you don't pay your principal and interest payment, okay? However, you do have to pay your taxes and insurance, any homeowner fees that you might have on a particular complex,
Correct.
or if you're in a mobile home park, you might actually have fees associated with that mobile home park. So you want to consider that in your budget when you're doing a reverse mortgage, because those are expenses you're going to have to pay. But quite a bit less than having to pay a principal and interest mortgage payment.
Right.
Right? So it's almost like, and I was telling you guys, what did I say when we first met? Let's do a strategy for your future. Let's make the first investment, we could make 50 to 100,000, and then the next one we can make another 50 to 100, and the next one another 50 to 100. And when you get to your third, fourth, or fifth investment, then you take the gain from all of those investments as you've been working on those for the last couple of years, and you put them into the home that you love, that you want to retire in. And that's your 50%.
That's your 50%.
Right? Because now you get what you actually want. So those investments paid off for your long term, which was the fact that now you can enter into a home with a reverse mortgage anyway and not actually have any mortgage payments.
Right.
Right. So what other questions do you have for her?
You've already touched upon and answered some of the questions we had. The primary question that was in our minds was, what are the risks and what are the benefits? You have mentioned something about that.
Right.
But maybe you can clarify and enlarge on that question.
Okay, great.
In risk and benefits as it compares, because I've talked to the two of them,
Right.
to getting a conventional loan at their age versus a reverse mortgage.
Right.
Okay, because they're going to buy a house.
Right.
Right? So now we're just deciding what type of mortgage is the right mortgage for them at their age as they enter into retirement.
Okay. So when Debbie said this was off the cuff, I had no idea this couple was going to be here. So I wanted to disclose that. So with that being said,
Let's not intimidate you.
yes, not at all, not at all. So when you look at it, it's like you are retiring and you can get a conventional loan, but then you have to pay a mortgage.
That's right.
Yeah.
And then you're going to concern yourself with the principal interest going down, right? Because that's the goal of having a normal conventional loan. If you have any heirs or anybody you want to leave that property to, what are you going to give them when there's a lien on the property,
That's right.
right? So that's the conventional loan.
Okay, so
go ahead.
with that, okay, just real quick to interject, and correct me if I'm wrong, but I understood that in the new regulations, if they have family, which I know you do, and I've had the privilege of meeting your family, and they do a reverse mortgage, in the old way, you could not, as a family member, purchase the house that your mother or father had in a reverse mortgage. But now you actually have the ability to purchase this house as a family member for as much as 10% below the appraised value. Am I correct in that?
Right, so the
Okay.
percentage is 5. So
Okay,
when
5,
the value
okay.
comes in, they can purchase it at 95%.
Okay,
Or let's say the reverse happens. Let's say there's not enough equity in the home.
okay,
Then it's an automatic short sale.
It's an automatic short
The
sale.
families no longer have to be burdened with that.
that's right.
So what happens with a lot of families, like, okay, this is my house, I lived in it, my family loves it, I want to leave this legacy.
Right.
But if you have all this debt on it, you're not, what legacy are you really giving them?
That's right.
So really you should have enough life insurance because they can, nothing personal, but they can get that within 30 to 45 days.
Right.
And not be burdened with selling the house and keeping the house or whatever the case may be. If you have a trust, which I always try to tell my clients, make sure you have a trust because you want to make sure that whatever your wishes are, you worked hard all these years. Right? What do you want?
That's right.
Where do you want this money to go
Yeah.
to? Who do you want to leave this to?
And then you guys need to make that decision.
Exactly.
And we had another segment here earlier today,
Yes.
title, where we talked a lot about trust. So if you didn't tune in on that segment, definitely take a look at it because a trust is definitely something you want to do as you acquire wealth, and any wealth is any real estate, because real estate goes up in value. You always have an equity position at certain points in the market.
Right.
Though up and down, there's always that up market where you have equity, and that is your wealth to leave to your family for an inheritance.
Right. So
You know?
if you want to be clear about the advantages and disadvantages, is you should have a strategic plan with this. If you're doing a reverse mortgage, you need to understand that the disadvantage of it is not reducing your principal. It's
Okay.
increasing it. So the way the new one works is that they've created the calculations differently so that it protects the homeowners as well. So that
Okay.
you don't have to worry about losing your home or anything like that because the value changed.
That's right. So say, for example, 2006, we had a crash in the market. If we ever go through a crash, and I've been in real estate for 30 years, I've been through a couple
so
cycles,
good.
right? I know, 30 years. And so what I was thinking was, no, I'm just kidding. So 30 years in the industry, I have seen my share of market crashes, two very significant ones. One in the 80s, and then when the interest rates were like at 17 and 18%, and then another one in 2005, 2006. So at that time, those reverse mortgages would have had value to the person who had them because the property values had dropped significantly. But the person who was in the reverse mortgage at that time, it wouldn't have mattered to them because even though it's a negative, there was now today it would be a guaranteed short sale, so they wouldn't have to worry, or their family wouldn't have to worry about the shortage, which you actually pay taxes on.
Right.
By the way, because this last change that we had in the market, a lot of people who went through the short sales, the very beginning parts of 2005, 2006, many of those people who did short sales actually had a tax consequence. Whatever your shortage was, let's say that your house was worth 500, you got a loan for 500,000, the house was worth 600, you got a shortage of 100, just easy math. You had to pay taxes on that $100,000, right? Until we actually had some laws change where we had some relief for the short sales, but that doesn't mean that that's going to be indefinite in the industry when it comes to short sales and paying taxes on the losses as it pertains to, the loss on a reverse mortgage as it goes up.
Right. So the disadvantage of the reverse is that it is negatively being amortized, which means the principal balance is not being decreased, it's increasing.
Right, for each month at the payment. So that
Correct.
payment goes up every month.
Right, but because of different calculations now that they've made, it's safer for the client.
Okay.
Because I didn't do the older ones, right?
Right.
But I feel very comfortable with the way they have it because now it's insured and we can protect our clients, right? Because
That's right.
what's the sense of being retired if you can't keep the home? The other portion is when we talked about is the credit line. So what you want to do is you have two choices. You can get a fixed reverse, but if you get a fixed, you don't get the equity line of credit. So
Okay.
I highly recommend that you get the equity line of credit because think of it this way. It's like a seesaw. So you have your principal balance going down,
Okay,
but if you get a equity line of credit, it's going up.
okay,
So if you qualify, and it's all based on qualification, which has changed compared to before.
Right.
So it's income-based, credit, things like that. So let's say you have a $200,000 loan, and it's being negatively being the balance is being decreased. Right?
Okay.
The balance, right? Because your principal, there's no principal, right? So every month that you don't have a mortgage is added to that principal.
so today
balance.
it's 200,000,
Then
tomorrow it's
tomorrow-
200,000, 225.
That's right.
Or 200,000,
It
2,500.
decrease- Right.
So
your
each month it
balance
goes
will
up.
always increase. So that's
Right.
the disadvantage if you look at it that way.
Right.
The difference is if you get a home line of equity line of credit, that 30 minutes, let's say you have 30,000 or 40,000, that's going to increase.
Okay,
Right, so that's going to increase on the same interest rate as this one is.
Mm-hmm.
So the key is to take out the reverse mortgage when you don't need it.
Right.
If you need it, there's another strategic plan for it because we want you to keep your home.
That's right.
But if you have it, so now you have an equity line of credit, so when people have it, now they can strategically say, okay, let me live my retirement. I have $50,000. Let me call my kids up. Hey, listen, I'm going to Cancun. I'm treating.
okay,
Okay, pack your bags, you take the money out of your equity line of credit, and you pay for the vacation.
Right.
Now, you have money that's coming in that's taxable,
that's right.
right? So when you take that money out because you have to, right, for certain reasons, that's taxable money. If you were to take that money out and then apply it to your reverse mortgage,
It would have no value.
it has value because that taxable money is going to be offset by you making a mortgage payment,
Right.
and then you increase your equity line of credit the same amount.
Okay, that makes a difference. We have a lot to talk about, and I like the idea that there is an equity line of credit because we've done so many wonderful investments together, and thank you for that, because we have actually become great friends, almost, we're family, right? Love you guys. And I'm like that with, very few people, so I appreciate that. And I want to see you guys succeed even beyond your retirement. We talked about taking this equity line of credit and using it for continued investments, and that's probably what we're going to end up doing if they do this. So thank you so much for joining us today. We're going to talk a little bit more about reverse mortgages at a later time. There's a lot more to cover. Thank you once again for joining us today live with Off the Cuff with Deb.